Hi, and welcome back to the channel. Today, we're talking about one of the most important steps in building long-term wealth, investing. If you've ever wondered how to make your money work for you, this video is for you. Many people think investing is complicated or risky, but the truth is, anyone can learn how to invest with the right approach. In this video, we'll cover the fundamentals of investing, break down key concepts, and help you take that first step toward growing your money. So, what is investing? At its core, investing means putting your money into assets, like stocks, bonds, or real estate, with the expectation that their value will increase over time, instead of leaving your cash in a savings account earning minimal interest. Investing allows you to grow your money at a much faster rate, and the earlier you start, the more time you give your investments to compound, turning small contributions into substantial wealth. One of the first things to understand is the relationship between risk and reward. Generally, investments that have the potential for higher returns also come with higher risks. Stocks, for example, tend to offer higher long-term returns compared to bonds, but they're also more volatile. Bonds, on the other hand, are usually more stable, but offer lower returns. By combining different types of investments, you can create a balanced portfolio that aligns with your risk tolerance and financial goals. Another key concept is diversification. Diversification simply means spreading your money across different types of investments, so that you're not overly reliant on any single one. Think of it as not putting all your eggs in one basket. For example, instead of investing all your money in one stock, you might invest in an index fund that owns hundreds of stocks. This reduces your risk, because if one stock underperforms, others in your portfolio can help offset the loss. When you're just starting out, a good place to begin is with broad-based index funds or exchange-traded funds, ETFs. These funds are designed to track the performance of an entire market, like the S&P 500. They're low cost, easy to manage, and provide instant diversification. By investing in an index fund, you're essentially betting on the long-term growth of the market as a whole, which has historically been a reliable way to build wealth over time. But before you invest, it's important to have a plan. Start by identifying your financial goals. Are you investing for retirement, a down payment on a home, or simply to grow your wealth? Your goals will determine your investment strategy. For example, if you're investing for a goal that's decades away, like retirement, you can afford to take on more risk and focus on higher growth investments. If you're saving for something in the next few years, you'll want to choose more conservative options to protect your money. In the next section, we'll dive deeper into building a portfolio, managing risk, and creating a long-term investment strategy. Let's move on and start putting these ideas into action. Now that we've covered the basics, let's focus on building and managing your investment portfolio. Your portfolio is simply the collection of investments you own. It could include stocks, bonds, mutual funds, ETFs, or even real estate. The key is to structure your portfolio in a way that matches your financial goals, risk tolerance, and time horizon. A common starting point is to determine your asset allocation. Asset allocation is the percentage of your portfolio you dedicate to different asset classes, such as stocks, bonds, and cash. A young investor with decades before retirement might choose an aggressive allocation, perhaps 80% stocks and 20% bonds, because they have time to ride out market fluctuations. Someone closer to retirement might shift to a more conservative mix, like 40% stocks and 60% bonds, to protect their capital. Once you've chosen an allocation, consider how to achieve diversification within each asset class. For stocks, this might mean investing in funds that cover large-cap companies, small-cap companies, and international markets. For bonds, it could mean a mix of government bonds, corporate bonds, and municipal bonds. By diversifying, you reduce the impact of any single investment's performance on your overall portfolio. Another important aspect of portfolio management is rebalancing. Over time, certain investments will grow faster than others, causing your allocation to drift. For example, if stocks perform well, they might make up a larger percentage of your portfolio than you originally intended. Rebalancing means selling some of the overrepresented assets and buying more of the underrepresented ones to bring your portfolio back in line with your target allocation. This ensures that your portfolio remains aligned with your risk tolerance and goals. In addition to rebalancing, consider dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money at regular intervals, such as monthly or quarterly, regardless of market conditions. This approach reduces the risk of making emotional decisions and helps you buy more shares when prices are low and fewer shares when prices are high. Over time, dollar cost averaging can lower your average cost per share and help you build wealth more consistently. Another strategy to consider is keeping an emergency fund separate from your investment portfolio. An emergency fund, typically 3 to 6 months worth of living expenses, provides a safety net so you don't have to sell investments during a market downturn. This gives you peace of mind and allows you to stay invested even when unexpected expenses arise. In the next section, we'll discuss how to stay consistent with your investment plan, avoid common mistakes, and maintain a long-term perspective. Let's move on to the final chapter and ensure your investments continue to grow over time. Investing isn't a one-time event, it's a lifelong process. After you've built your portfolio, the challenge becomes staying consistent, avoiding common pitfalls, and maintaining a long-term perspective. In this final chapter, we'll discuss how to keep your investments on track and ensure they continue to grow over time. The most important factor in successful investing is patience. Markets will rise and fall, sometimes dramatically. It's natural to feel nervous during downturns, but history shows that markets have always recovered over the long run. Instead of trying to time the market, focus on time in the market. By staying invested and avoiding emotional reactions, you allow your portfolio to benefit from long-term growth. Another key to consistency is regular contributions. Even if you can only invest a small amount each month, those contributions add up. As your income grows, increase your contributions whenever possible. The more you invest early on, the more time your money has to compound, leading to greater wealth over the years. Automating your investments, setting up monthly transfers into your brokerage or retirement accounts, ensures that you stay on track without having to think about it. It's also crucial to review your portfolio periodically. Check in once or twice a year to see if your investments are still aligned with your goals and risk tolerance. If your goals change, such as retiring earlier or saving for a child's education, adjust your allocation accordingly. Revisit your asset allocation, rebalance as needed, and make sure you're still comfortable with the level of risk in your portfolio. Regular reviews keep you informed and confident in your investment strategy. In addition to reviewing your portfolio, consider the importance of diversifying your knowledge. The more you understand about investing, the better decisions you'll make. Read books, follow trusted financial experts, and stay informed about market trends. Financial literacy empowers you to navigate changes in the economy and adapt to new opportunities. By continually improving your knowledge, you'll feel more secure and capable of growing your wealth. Another important aspect is managing your emotions. Investing can be emotional, especially during volatile markets. It's common to feel the urge to sell when prices drop or to chase returns when they rise sharply. Recognizing these emotional triggers and reminding yourself of your long-term goals can help you stay disciplined. Remember that temporary market fluctuations are a normal part of the investment journey. By keeping a level head and sticking to your plan, you give yourself the best chance of achieving your financial objectives. Lastly, consider how investing fits into the bigger picture of your financial life. Building wealth isn't just about accumulating a large portfolio, it's about using that wealth to create security, freedom, and opportunities for yourself and your loved ones. Over time, your investments can fund your retirement, help pay for your children's education, or provide you with the freedom to pursue passions and experiences that matter most. By focusing on the life you want to build, rather than just the numbers on your account statement, you'll stay motivated and make decisions that truly serve your long-term well-being. In summary, investing is a journey, not a destination. By starting with a solid foundation, building a diversified portfolio, and maintaining consistent habits, you can achieve your financial goals and enjoy the long-term benefits of compounding growth. Thank you for watching. If you found this video helpful, don't forget to like, comment, and subscribe for more investing tips. Share your investing goals in the comments below. I'd love to hear how you're building your wealth. Until next time, take care and happy investing.